The new year is right around the corner, and the usual question of what stocks should I own in the next year comes up again. So therefore, in today's video, we're going to take a look at the 4 best dividend paying companies you should own in 2021. As a special perk for all the value investors among you, I will also include a graph with a fair price and the company's actual price, so that you can identify deals way faster. This is Might As Well Invest, becoming smart money. On a side note, only a small portion of you that watch my videos are actually subscribed or end up smashing the like button. So if you end up liking this video, consider doing both of these, as they are free and you can change your mind at basically any time. Now enjoy the video. Coming in the first place, we have a company of which I've been a huge fan for quite some time now, which can be attributed to the fact that it pretty much has perfected its market and therefore is making money like crazy with their various services. But who exactly is this cash cow? Well, let's lift the curtains and reveal the first company of today, which is JP Morgan. As I've already said, JP Morgan is one of my favorite holdings and has been for quite some time now. I'm even so confident in them that they are literally my only finance play in my dividend portfolio. Although I think that almost everybody knows the company, let's get a really quick introduction out of the way. JP Morgan operates as a financial service company on a worldwide basis, providing services in the consumer, community banking, corporate investment banking, commercial banking, and asset and wealth management segments. With that already comes one of the, in my opinion, huge upsides of JP Morgan, and that is that they are pretty much a household name in each one of their segments, allowing them to have a pretty tight grip on the market, meaning that they also have a pretty big moat. This leads to a situation where whatever they do, at the end of the day, their pockets will be full either way. This more or less has also been confirmed by the recent crisis, or more so pandemic, from which especially JP Morgan has largely been unaffected, passing the bank stress test with pretty much ease, allowing them to now again return sizable amounts of capital to their shareholders through a fairly sizable amount of dividends, but also a 30 billion stock buyback program in the year of 2021. In addition to that, I personally also see the trend of rewarding shareholders and producing huge amounts of cash continue for years to come, making JP Morgan not only a company for 2021, but also for years to come. As promised for the value investors among you, using the dividend discount model, we would get a current fair price of $148.76, showing us that JP Morgan currently is trading at a huge discount, allowing us to take advantage of the discount, but also of the company's distributions later along the way. Our second company of the day is a company which I would consider to be a textbook buy and hold forever company, that in my opinion has the potential to provide shareholders with immense upside in 2021 and even for years to come. This is a company which I have actually already covered on this channel before, but let's lift the curtain to reveal the first real estate company of today's video, which is Store Capital. Store Capital is one of the probably lesser known real estate companies. However, it is safe to say that they recently got quite a bit of love from various YouTubers, but also the famous investor Warren Buffett. But let's start out with the usual breakdown. Store Capital owns, operates and manages a diversified portfolio of net lease properties located across the US. First of all, I believe one of the biggest upsides of Store is its business model of net leases, which solves one of the biggest issues for their tenants, and that is to actually free up capital which they would otherwise have to spend on actually buying the real estate themselves. Therefore, renting the location from Store is not only way cheaper, but you are basically treating it as if it's your own. That means that the tenants of Store actually do most of the maintenance themselves and only pay their monthly rent to Store, which therefore doesn't really have to worry about too many things. All of this leads to something which I consider to be fairly untypical, and that is that they are actually able to achieve higher returns at basically almost the same risk. If you are looking for a more detailed breakdown of why that is the case, you can check out my video on Store Capital specifically. Last but not least, I actually have a fairly untypical upside to Store, which however still is at the forefront of my investment case, and that is Christopher Volk. Christopher Volk is the CEO of Store, And he's not only a man with a ton of experience in leading REITs to success, but he's also got strong conviction for the company itself, which is one of the leading factors in the success of a business, as you can see with companies like Tesla, Amazon, and so on. In terms of the numbers, Store is still looking quite attractive. While it isn't trading at a huge discount, it is still safe to say that their current price is still below the company's fair price of $37.66. Therefore, I personally would definitely buy the company up to that point. Our third company of the day is a little bit different in its nature when compared to JP Morgan or even Store Capital. However, although the company is a little bit different than the ones before it, I'm still a huge fan and would sincerely say that this is not only a company for 2021, but one for ages to come. The company which I'm talking about is not only in the pockets of many, but it's also the favorite fruit of some of us. Do you already know which company I'm talking about? Exactly, I'm talking about Apple, which I think does not need an introduction, but yet is a company which should be an absolute staple in both a growth but also dividend portfolio. While this might sound somewhat counterintuitive with the company reaching new all-time highs on an almost weekly basis, it actually has quite a few upsides that lead me to believe this is actually the right time to buy Apple. But hear me out on why I think so. First of all, it is safe to say that Apple follows a marketing strategy which is straight up genius and gets customers into the company's huge ecosystem of various products, all linking up with each other. With that also comes the, in my opinion, biggest upside of Apple, which is that the company has recently taken a lot of steps to become an even bigger part of your life after you have bought an iPhone, a Mac, or whatever it might be. They do this through what I consider to be a huge offensive in the service segment, with the peak obviously being the recent rumors about the self-driving EV car made by Apple. Combine this with the fact that Apple, with their cash position of $90 billion actually has the fundamentals to support their actions, and you get a company that should be really hard to stop in the future. When it comes to getting a fair value for the stock with the dividend discount model, this is a little bit harder to do, as the model isn't quite as accurate with low yield but high dividend growth companies. If we, however, proceed with the usual calculations, we would land at a fair price of $54, to which I have to say, throw it out of the window and buy the company. Our fourth and last company of the day is another company which I have already covered on this channel in a video on its own. However, since I think this company has immense power to become one of the best turnaround plays for 2021, I still wanted to include them in this video as well. Since I have made quite a mystery around the companies before this, let's skip all of that. Our last company is the one that has been creating our heroes for years, and that is Disney. Disney is another one of these companies that doesn't really need an introduction, as you most likely know the company since the days you have been a child. However, the last year has been quite a strange one for Disney, as it resulted in the company's biggest segment, which is the parks and products segment, having to shut down due to the pandemic, leading to a revenue decline of about 61% in just this segment. At the same time, we however saw the company's various streaming services like Disney+, ESPN and Hulu basically becoming market leaders in the blink of an eye, to the point where we can now say that these services have surpassed the forecasts for the year of 2024, or are at least well on their way to do so in 2021. This can obviously be attributed to the lack of open cinemas and a lot of people sitting at home having nothing to do. But obviously the entertainment offers, especially from Disney Plus, should not be discredited, with the show The Mandalorian, for example, contributing record numbers to Disney's overall performance. And I sincerely think this trend will continue, as I personally see Disney Plus as the streaming service which will also be very popular among families, simply due to the wide content variety. Now combine this with the fact that it is pretty likely that Disney will be able to reopen their parks and maybe even offer cruises in 2021, and you actually allow Disney to get their biggest revenue contributor back on track, resulting in a company coming out stronger from this pandemic than when they entered it. Similarly to Apple, it is quite hard to value Disney using the dividend discount model, as they currently don't pay a dividend. Since I at least want to offer you a price for orientation purposes though, I'll be using the numbers they would have offered without the pandemic, which I also used in my previous video on the company. With these calculations, Disney would have a current fair price of $130.73, meaning you currently would have to pay a premium, but I think there are worse ways to spend your money. Last but not least, thank you very much for supporting me throughout this year. It has been an amazing year for this YouTube channel, and I sincerely never expected almost 300 people to sub or even give a damn about my opinion on stocks. I wish you all a great start into the new year and hope to see you around for my next videos and hopefully even years to come. This was Might As Well Invest.